Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets. Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. This week we address some of the recent comments by Canada's Finance Minister and some of her concerns about whether Canada is suffering from what she called a Vibecession. Before I get into our slide deck, I want to be clear. The goal of this video is not to scare people. One of our core values at IceCap is that knowledge is power, and we believe being well-informed can help you overcome any fear of the unexpected and mitigate risks to your portfolio. I'm sympathetic to the constraints some politicians face, but Canadians are grown up enough to understand the challenges that lay ahead of us and are strong enough to overcome them. Okay, enough philosophy, let's get into it. This week, the federal government announced the following: a 2-month GST HST holiday on essentials like groceries, restaurant meals, snacks, children's clothing, gifts, all starting in December, and a cash handout $250 for anyone making less than $150,000 a year. Leaving aside the logistical difficulties for thousands of small businesses that will be forced to implement this, it's a dumb policy. Number one, these two programs are expected to cost $6.3 billion. Money the federal government will have to borrow because it's already running a budget deficit. Number two, even if you thought taking on more debt for a one-off cash handout was a good idea, the policy is not targeted, and in some cases, highly regressive, meaning richer people actually stand to benefit more than poor people. For example, by dining at very expensive restaurants. Number three, Canadian workers are already taxed to death. The $250 rebate is actually less than 2 weeks of federal tax payments for most of Canadians. And in April, the carbon tax is set to rise yet again. The move is also particularly cynical because of the timing and frustrating because of the motivation of these announcements. I promise to stay away from politics on this channel unless there's a direct link to the economy, as there is today, but let's call a spade a spade. The Liberals are getting killed in the polls, and this is a cynical Hail Mary combined with a desperate attempt to get Bill C-63, the online harms bill, over the finish line. But the kicker for me is that the finance minister stated, and I quote, "One of the positive impacts of this measure is to help Canadians get past that Vibecession, because how Canadians feel really does have a real economic impact." So what is a Vibecession, you ask? It's a period when the economy is doing well, but the public's perception of it is negative. She then went on to infer that Canadians are simply mistaken. In short, your perception of the economic reality is wrong. The economy's not weak. It's fine. And by the way, there's definitely no affordability crisis. What a joke, and I'll explain why. First, the BOC is worried, and I'm pretty sure they do not think it's just a Vibecession. How do I know this? I'll remind you that the BOC cut interest rates by 50 basis points in October. This was exceptional. I know that 0.5% doesn't sound like a lot, but this never happens. Not in one meeting. It only ever happens if there's a crisis or an emergency, as we saw with September 11, the global financial crisis of 2008 and 9, or COVID. Furthermore, just today, Mr. Mendez, Deputy Governor of the Bank of Canada, hinted that the BOC is concerned about deflation and the negative psychological impacts downward price spirals can have on an economy. But enough of the vibes, let's look at the data. Canada is already in a per capita recession. A falling GDP per capita means Canadians are, on average, becoming poorer. GDP per capita has been falling for 2 years, and over the last 12 months, it's down 2.3%. In the presser, Freeland cited an upgrade in the GDP forecast by one of Canada's banks. And I'm here to tell you that one should never cherry-pick a single positive forecast when there are consensus economic estimates freely available, as you can see on the right-hand side of this chart. And according to that consensus, unless population growth falls by more than half, from 3% to 1.5% next year, GDP per capita will again be negative. Stepping back, we can see that Canadian real GDP per capita is at an 8-year ex-COVID low. But critics of this analysis will rightly point out the recent population jump distorts these figures. So, as a simple example, we use the pre-COVID population growth trend, which is about 60% of what we've seen the last couple of years. And guess what? The result, GDP is still below its pre-COVID peak, and Canada is indeed in a per capita recession. As a small qualifier, this is admittedly simplistic analysis. This is because a large part of GDP comes from consumption, which in turn comes from the number of total consumers, i.e. population. But even with this generous oversimplification, Canadian economic growth is meaningfully lagging its pre-COVID trend, and this is extremely worrying. What if we compare it to the G7? Again, on both counts, as we can see from the chart, those red lines at the bottom are lagging the rest of the G7. The G7 is a stupid comparable anyway, so let's dig deeper. What about the labor market? Labor markets behave differently depending on how old you are. Such is life. But again, we see the unemployment rate is rising for all three major groups. And even for prime age workers, the unemployment rate is at an 8-year high. You'll also note that these figures don't rise unless we are entering or are in a recession. You can see by those gray bars there. So what about consumption? Here we see that real per capita consumption of both retail sales, which is dominated by goods, and services consumption is on the decline. But Rich, you might ask, won't a cash rebate and tax relief help consumption on the margin? It can, in theory. But the problem is that debt service ratios, interest payments relative to disposable income are at an all-time high for households. This means that many households will simply use the cash to pay down their credit card debt or their mortgage debt. In fact, we expect this figure to rise as mortgage renewals come through next year. $250 will not move the needle or meaningfully change this number. And this number being so elevated will keep the pressure on spending and the largest part of GDP, consumption. Lastly, for households is the wealth effect, which is a simple idea that people spend more as the value of their assets rise. Well, guess what happens when their house prices fall? That's right, people spend less. This is especially true for Canadian households that have so much of their wealth tied up into housing. Now, it's fair to point out that some housing markets are still doing well, for example, Montreal and Calgary, but this chart and this data is definitely playing its part. Okay, enough with consumers. Well, businesses too are also feeling the pinch. Here we have business insolvency proceedings, which I think is pretty straightforward. Companies are going out of business at a rate not seen in 15 years. Taxes, regulation, higher interest rates, wages, weak demand are putting companies out of business. And I assure you, it's not the vibes. It is increasingly difficult to run a business in Canada. It is a poor place to invest, as evidenced by our growing net direct investment outflow, which is the subject of a different video. This has led to capital shallowing or capital dilution when CapEx per worker decreases. This lack of business investment has led to a decline in capital intensity, which of course leads to my favorite subject, falling productivity growth. All to say is that Canada is not suffering from a Vibecession. We're in a full-blown recession, and it might even get worse than that. Obfuscating that reality and telling individuals that they are not feeling what the data is clearly showing, to me, is not only ineffective, but I think hides the truth from Canadians who might not otherwise be exposed to all the data that you and I are. $250 might sound like a good idea, but it's going to do nothing to address the real problems that Canada and Canadians had, which is weak demand and poor productivity growth. So that's a wrap on this week's episode. Thanks very much for listening. Please like, subscribe, and follow for more, and feel free to get in touch.